Morning. Welcome to Ainsley News. It's 14th of December. Today we're talking Rickards on why gold is ready to rumble. Jim Rickards' latest outlook for gold looks at the reasons for the recent correction and also why and where he thinks it will go from here. We know readers love him, so here is a summary, and we'll also include that full article for you to read too. Jim talks to the 14% fall from that all-time high of $2,063 in late August to $1,769 at the end of November, and the fact that some investors were spooked about further falls despite the healthy bounce off the 30th of November low. So what caused that correction? Rickards cites 4 factors. Point 1, rising interest rates. The rising yields in US Treasuries or USTs saw a rotation of funds out of gold into bonds as buyers saw the lower bond prices from higher yields as a buying opportunity too good to ignore. Point 2, US election. The Goldilocks outcome of a Biden presidency but Republican Senate meant that big stimulus but not the extreme policies of the far-left Democrats. That is, nirvana for the stock market but diminished the need for safe haven gold. Point 3, vaccines. With the vaccine, everything turns awesome and strong economic growth sees funds going to shares over gold. And point 4, paper gold action. Given the reality that the spot price of gold is dominated by paper trades such as futures and ETFs, high frequency, algorithmic trading can see price movement outside of fundamental forces. Futures trading is automated and relies on algorithms that mimic other algorithms. The result is that when prices decline, more sell orders are triggered, momentum builds, stop loss levels are hit, leveraged players cover their losses with more sales, and so on in a recursive dynamic that overshoots fundamental valuation based on money supply or economic predictive analytics. That's just how leveraged automated markets work today. So where to from here? Right now, my models are telling me that the dollar price of gold is heading significantly higher. Why? Firstly, talking to the rising rates piece, Rickards points out that each time yields on USTs have risen on hope-based narratives, economic reality has pushed them back down, and each low is lower than the past. For example, on the benchmark 10-year note, May's 1.3%, July's 1.28%, and August is 0.5%. Whilst Rickards doesn't directly address it, in TA or technical analysis, a pattern of lower lows is usually bearish. However, despite these large fluctuations, the trajectory of gold has remained firmly upwards, as plotted against a simple moving average. Is that chart shown here? At each dip, reality quickly asserted and the price rebounded. Rickards believes the same is happening right now. The reality today is that coronavirus cases and fatalities are spiking. New lockdowns are coming and we're heading into another recession, following the first recession from February to July 2020. Rates will fall again, this time to around 0.35% or lower. This will provide an enormous boost to gold prices. In terms of the election, he believes the very real prospect now of the Democrats winning both Senate seats in Georgia on the 5th of January means a Democratic Senate. Or Democrat Senate, no gridlock and the likes of the new Green Deal becoming a reality driving gold higher. He doesn't mention it, but that also turbo boosts silver as the key ingredient for solar panels, as we've previously discussed, and also platinum. In terms of the vaccine, he simply points out the bleeding obvious, and that is we are 6 months to a year away from that being broadly available, too late to avoid the economic damage that's already been inflicted in the US and Europe in particular. And to wit, we are in a Great Depression, or a new Great Depression. The adverse effects will be intergenerational. Most of the small businesses that closed will never reopen. Bankruptcies are skyrocketing. Job losses will be permanent. The disease is still raging. New lockdowns will produce a new recession. Again, the stock market has priced a recovery based on cap-weighted indices that favour tech companies that produce relatively few jobs. The real economy of small and medium-sized enterprises, about 45% of GDP and 50% of all jobs, is flat on its back. This will reveal itself in terms of higher savings rates, reduced consumption, and reduced labour force participation. And finally, on the fourth point around the algorithms, well, the reverse is often the same. Finally, momentum is a two-way street. The same forces that cause the gold market to overshoot on the downside will cause the next rally in gold to overshoot on the upside. Buying begets buying. Leveraged shorts will rush to cover and robots will buy for fear of being left behind. Since August, gold has faced headwinds in the form of higher rates, political trends, rosy economic scenarios, and leveraged momentum. Those headwinds are about to turn into tailwinds as the economy slows, rates fall, and political uncertainty grows, and momentum swings to the upside. Savvy investors will buy gold in its current trough, and they can enjoy the ride back to $2,000 from there and then much higher. You may recall Rickards is predicting $10,000 gold. We're going to include the rest of that article linked here in YouTube and also our other channels too, and you can go over to Ainsley Bullion and read that in full as well from Jim Rickards. Well, thanks for listening to news today. Remember ainslebullion.com.au for all things physical, ainsleywealth.com.au for Bitcoin, Ethereum, and large cap cryptocurrencies. And check out goldsilverstandard.com.au for our own cryptocurrency built and backed by Ainsley and stored at Reserve Vault. goldsilverstandard.com. We'll catch you tomorrow for more news.